Well, good afternoon, everybody, and welcome to our January 26th pre-Super Bowl, pre-Groundhog, pre-February, end of January session of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by Ken Kavula from a few miles to the north and a couple more inches of snow. Good afternoon, Ken.
Good afternoon, everybody. Glad to be here on this wintry afternoon. This is the kind of afternoon that I don't mind staying inside because of COVID and everything. So,
Well, as long as you're packing mittens like Bernie, you're safe. So, Bernie did sneak onto our slides. We got rid of the Santa caps, but nobody can hold back Bernie these days. Kim Butcher is also joining us from Florida, where it is not snowing.
No, the sun is shining. You better have your sunscreen on.
Wow. Such differences. All right, well, we've got a whole lot of stuff to look at. We want to talk about market froth. And then we're just going to roll through a bunch of our favorite screens. We're not going to spend a lot of time on the individual stocks. That's your mission. Much like the Blues Brothers, you've got a full tank of gas and a bunch of shopping lists that we're going to share with you. And we invite you to share any other ideas as we continue this theme a week from now, as that will be the end of the current Groundhog Challenge and the beginning of the next one. We actually already have about 20 participants in next year's Groundhog Challenge. Some of them, including some of the attendees in the audience, would like to keep the gains that they've gotten over the last several days. But they will be reset to $1 million Groundhog dollars on February 2nd. So let's go ahead and talk about some of our favorite sources of ideas and screens and just a couple other things that are on our mind. All right, here's your reminder, standard boilerplate disclaimer. No investment recommendation is intended. This is an educational demonstration. It is all about illustrating the methods and techniques of the modern investment club movement as championed by the National Association of Investors / Better Investing, or as interpreted and championed by Manifest Investing. The opinions and stuff that we talk about are our own. We also try to, or strive to, disclose when we have an actual position in a company that we talk about. The round table is this evening, so some of the work that you see here this afternoon will be on display tonight as we make our selections for the January roundtable. If you or someone that you care about would like to be reminded of the monthly sessions, send an email to nkavula1@comcast.net. You can also go to betterinvesting.org and the Mid-Michigan chapter, and there's a do-it-yourself opportunity to sign up for that reminder list there. If you want to copy the slides, and again, just your reminder, are you Manifest subscribers out there? First of all, God bless you and thank you. Second of all, you know that we put copies of all these slides in the Manifest forum, so you don't have to feverishly jot down all the tickers you're about to see. You can go find them there and then continue your homework from there. If you do have follow-up questions or suggestions, markr@manifestinvesting.com is my email, and that'll get to me, and we can crank away on that too. All right. Here's just a quick look at our bullpen. We will be covering these topics in days ahead. We have touched on several of them that we'll be returning to, but again, if you have suggestions or things that you'd like to see us kick around, we would be happy to do that. It's our plan to do this as long as there's an appetite for it. Any comments or questions, Ken?
no, let's get looking at these companies. I found them pretty interesting when I reviewed them this afternoon, Mark.
Yeah, Ken has probably got a side bet that there's no way we're going to get through these slides in an hour or so. All right.
I knew that right from the beginning, Mark. So.
Let me go ahead and mount the soapbox here for just a minute. We have talked about bubbles here in the last few weeks, and there was actually an article in Market Watch. Pretty sure that Len Douglas brought this to my attention and goes so far as to quote Jeremy Grantham, who is, again, as I've said, I'm not picking on Jeremy. He's one of my heroes. I think he's one of the masters of investing. over the last many, many years. But he can be pretty bearish, pretty persistently bearish. And he's pretty bearish right now. He does not see a whole lot of stocks that are of interest to him right now. And I just have a nit here. The publishing world drives me crazy. They misspelled his name on the slide. Can't believe it. Right there. Well, my Madden thing isn't working, so we'll just move on. Just love it when they do that sort of thing. All right, let's talk a little bit about bubbles and what you should think about them. First of all, they come and they go. They are not as dangerous as they would like you to believe. This particular Barron's cover is from November 2013, and it would represent the end of that upper stock chart's price chart on the Vanguard Technology or Information Technology Sector Fund. And of course, that's going to be your Microsofts and Apples, etc., in that particular fund. And yeah, it had soared pretty well over the years from 2004 to the end of 2013. And there was all kinds of articles like this out there suggesting that, most of them had really meager return forecasts, low upside downside ratios, just a whole lot of risk. And lo and behold, if you just grit your teeth, buy the best companies when they're on sale, you can participate in what actually proceeded to happen. And that's the bottom chart, which starts at the time of the issue of that magazine cover and going for the next 10 years. I think it's just staggering. It's just a reminder that, maybe you ought to just look the other way or hum one of your favorite tunes when you see a magazine cover like this. Notice how long and how persistently that Vanguard Technology Sector Fund has been overpriced. As denoted there by the green areas in the RSI chart. They can stay there for a long time, folks. And it's just one input, one parameter to keep in mind as you're thinking about your portfolios. Anything jump out at you here, Ken?
Well, I don't know if it jumps out from these charts right here, but I listened to a discussion this morning on one of the business channels and found myself intrigued by an idea that I had heard for the first time. Mark, do you know anywhere where we could actually get a graph of cash sitting on the sidelines or uninvested cash or anything along those lines? Because the premise of this argument was that, and this gentleman had data to back it up, but I don't know where the data came from, and I'd like to explore the data myself.
Mm-hmm.
He made the point that he didn't feel there was as much of a bubble as a lot of people were talking about because of the inordinate amount of cash that was still sitting on the sidelines. And his premise again extended, and he said that as long as there was a lot of cash sitting on the sidelines, it was going to be able to control what was moving with some of these stocks, and he viewed the market as having a lot of little tiny bubbles that were coming to the surface and popping. And if you looked in sub-industries, you could find a number of those, but overall there were no large bubbles forming because the cash was keeping everything under control. It's an interesting idea. I'd like to pursue it, but if anybody has a source of data for amount of cash either sitting in brokerage accounts or quote sitting on the sidelines, whatever that means, I'd like to have access to some of those graphs and take a look for myself. What do you think of that idea, Mark?
I think it has merit. I also think there's that large investor known as the U.S. government that has not, to my understanding, has not fully deployed all of the emergency reserves or whatever you want to call them. As you may recall, Mnuchin had a large pot of money for making a bunch of investments, and he did, but I don't think he invested at all. And I don't know the status of that either, but I do have a chart which shows that, so I'll pull that up. And then the other thing that I've noticed that I think underscores kind of what you're talking about. When you're looking at the holdings of mutual funds and exchange traded funds, a lot of times they report their cash. But what I find so many of them doing now is they have these reserve note, basically a money market fund embedded within the holdings. So you look up at the top and it says, yeah, I'm 5% in cash. And then you scroll down and then they've got this reserve, basically CD, which is another 5%. So they're really 10% in cash. And I'm just seeing that all over the place as we, in the funds that we're ramping up the coverage on. So there is a number of that type of stuff out there. Any thoughts on this at all, Kim? We may have lost Kim. She warned me that she might have to step away.
No, this time it was me not recognizing I had muted myself and I need to unmute. I have had some great stocks that were kind of like this Vanguard informational ETF because they stay high forever and you think you need to get rid of them, but they might be one of your core holding that does the absolute best. So, watch your stock and understand your own individual stocks and how the management team does it. And are we a frothy? Are we at a top right now? That's each individual stock. It may not. If we are at a bubble, make sure each of us needs to have our pounce list available.
Absolutely. All right.
Mark, we've gotten a question from our audience about why the right-hand side of the top graph does not seem to match the left-hand side of the bottom graph. It appears that this is supposed to be one continuous chart, and I know the scale has changed considerably, but it looks like the stock price has gone from $77 and change at the right-hand side of the top to something much lower when the graph begins at the bottom. Can you tell me what's happening there? Or tell our audience what's happening there?
I think it's still a match. I think that bottom line that's kind of covered up by the volume chart is still 50. So it's just above. It's in the same neighborhood of the 77 to 80, on the left-hand side of that lower chart. That just happens. So it's a optical illusion.
Well, and this might be a little bit of an overlap as well then, right?
Yeah, it could be a mismatch in dates a little bit, but I don't think so.
Yeah. Okay. All right. That's as good as we can do, folks. But the charts were graph using an outside source. These are not graphs that Mark generated. They're coming from an outside source. So.
All right. Don't want to spend too much time on this, or Ken's going to be right about having too many slides. The message, keep your eye on the blue line. Basically the long-term trend of the market, yes, the green bars are above the blue lines. It's not like that hasn't happened before. And yeah, there's going to be a future white space below the blue line, but get over it. Get out there and buy better companies at better prices and stop worrying about the stuff that's zigging and zagging on that chart. Focus on the blue line. And when in doubt, here's another blue line to focus on. This one actually applies to somebody who might be in capital preservation mode or far enough along in their lifetime experience that these things are more important to them. What do you do in a market like this? What if the bubble people are right? Well, you stick to the higher quality companies. And this is just one example. The Jensen Mutual Fund is one of the higher ranked quality mutual funds out there anywhere. There's an example of their holdings, their top 10 or 12 holdings are right there in front of you. That's the other blue line to watch. The blue line for your personal investing campaign. And make sure it's in the right place. All right. A little more craziness to talk about just briefly. I don't know how much the audience has been, because we're not traders and we really don't pay attention to the market every day, but there is something weird going on that I think we've got to at least throw our hands up and flag. What this basically amounts to, in my opinion, I'm not gonna mince any words here. This is market manipulation. Whether it's illegal or not, that's for somebody else to decide. But you basically have a bunch of people that are connected on social media now that are basically wreaking havoc with some of these companies. This happens to be GameStop. This is a company that appeared to be headed for bankruptcy. And they're having a pretty rough go of it. And they did put a new member on their board a few days ago, so there was a news item from a successful company. But there's this group of people that hang out on Reddit. And by the way, there are 2.5 million people subscribed to this discussion group. And they've got their Robinhood accounts or whatever. And I mean, that's just not normal price action. That's one day, by the way, that chart on the left for GameStop, starting down in the 30s in the morning and hitting the 70s by mid-afternoon. That's not exactly normal. It does happen from time to time, but it hit 132 yesterday afternoon for a while. So it was up 100% in about, that's in an hour. Yesterday morning.
Well, Mark, this company had an inordinate amount of shorts holding the stock, and is this an example of the ultimate short squeeze with everybody moving to buy it, and those folks that are holding it short having to pay outrageous sums to get the stock back? Is that what's happening here?
Yeah, it's kind of amazing. You've got a couple of major hedge funds. These are big players in the industry that make their short positions known, and this social group on Reddit is attacking them. So, one of the things I kind of want to try to figure out is what are they going to attack next, because there's an opportunity here. Granted, it's non-core and it's a trading opportunity, but there is a crazy opportunity here. I mean, here's a
George is telling us they're doing this on AMCX as well. I don't know what that company is, but
it's some
message.
AMC theaters. They're also
absolutely okay, right.
They're also messing around with the BlackBerry and a couple others like that. Nokia is getting a little bit of action, but I mean, look at the amount of price action. This is a chart like we never put up on Manifest Investing. These are 10-minute intervals. So you're looking at just, I believe that's 3 days. Yeah, 3 days, Thursday, Friday, and Monday. And I looked a few minutes ago, it was back up in the 120 to 130 range again. So, I mean, it went from 60 at the open yesterday to 160 at one point in time. You can see that up at the top up here. And I actually used it as an opportunity to do a little bit of an experiment, which cost me probably $100, but I wanted to see if I could play with trailing stop limit orders on an intraday basis. And you see this little black line that came down here and kind of just spiked down for just a few minutes, Ken?
Yep.
You want to guess how close that came to my trailing stop limit order? It triggered. I mean, I got caught by like 2 cents, and otherwise I'd be up like 60% today with a trailing stop limit order. So, all right, that's enough.
Mark, George is telling us that AMCX is AMC Networks, and that's a different stock from AMC Theaters.
Oh, okay. My apologies. That's what I thought I had read.
Okay. And the group that's doing a lot of the attacking, he says, is called the Wall Street Bets.
Yep, and you'll see it referred to as WSB. That's the actual short name on Reddit, and it's a fascinating thing to watch because these guys are beating up on some major players. There were 2 major hedge funds that actually had to put between $2 and $4 billion in to cover some of this activity. So that merits a wow. And it's certainly something that you should be aware of, especially if you happen to know Groundhog owns, at least in the current contest, GameStop.
I don't like the up and down nature of any of this, but my gut instincts say to feel a little bit happy for the little guy for a change, who is out in front of the big guy. And actually doing a little bit of chaos to the fact that usually it's the other way around. We get dragged around by people doing things that we can't influence. But here's a bunch of small accounts banding together and really greatly influencing. Now, I don't think it's a stock market when this kind of thing goes on. It's more of a game, but at the same time, like I said, my gut says to feel kind of good about it for a change.
Yeah, and I only bring it up for the purpose of awareness. If it got out of hand, if, for instance, one of those major players or a group of those major players started doing some similar things, it could get out of control. And it's just something to be aware of. It's just a nasty situation. All right, let's talk about positive situations. We whispered a little bit about a potential conference a few months from now, and that is under consideration, but I just wanted to remind everybody of the successful investing 1 and 2 conferences that we held back in May of last year and November of last year. We nicknamed the conferences the COVID cancellation conferences 1 and 2, and these were the 26 selections made by our stock panels at them. And we do like to check in from time to time and see how we're doing, and lo and behold, we are, in terms of absolute returns, we're 26 for 26, so that's not so bad, Ken.
No, they're all green. That's a really nice thing, and the vast majority of them are green in relative return as well. If you had kicked me off the team and just let me be the master of ceremonies, our percentage would go up quite a bit. I have 4 near the bottom here, but that doesn't happen all of the time. But I'm taking my lumps on this one, I'll tell you.
Now, Ken, I have to toss some shame at you. I mean, I told you yesterday, I think General Dynamics is a pretty good long-term situation. And if Cy Lynch were here, he would say, hey, this is a work in progress, baby. You got to let these things go for a while. And I think a company like General Dynamics is going to be fine over the long haul.
Well, and I would second that on AbbVie as well. I think those are both good, strong companies, but they're certainly not matching the market. Although the other side of the coin is if I can identify a dozen companies that are all going to give me about a 20% return, I'm not going to worry too much about what the market happens to be doing if I'm sitting in retirement.
Absolutely. You can see that Kim is doing very nicely with mostly winners there. And I did invite Pat Donnelly to participate in an upcoming program, and he will, but he couldn't make it tonight, unfortunately. But obviously, Mr. Donnelly is, I really would like to figure out what Pat eats for breakfast and lunch. Because, and I'm cool too. And Herb will probably.
Well, it's fascinating that Herb has the best performing from the last conference and the worst performing. So he bookends the top and the bottom there. That's very interesting as well.
The worst performer is still positive. You can't complain too much either.
Yep.
Good stuff. All right. Speaking of contests, just a quick check-in on this one. This continues to blow me away. This is the current edition of the Groundhog, which now has 1 week until we close the doors on it and hand out the awards. Over 80% of the people who are playing are beating the market. That's unreal. The average return is now up to almost 50%. I mean, I have a 28% return. I was feeling kind of good about it till I looked around and saw what everybody else is doing. And, I mean, there are spectacular.
I'd like to know, if you don't have my name on here, I know I've got to be below you, Mark.
Well,
yeah, you've had much stronger years, and in your case, we were just picking on Ken with a couple slides ago. In your case, you have to rely on the fact that you have 8 winning years. You win every year.
That's terrible, Mark. Don't.
Well, her result.
I've got broad shoulders. I can take it.
Her
next year
results.
I'm going back playing.
Yeah.
I will say that Cy and I, that are usually the hold steady kind of guys, we're beating the pants off of you and Hugh right now, Mark. So that's good.
We'll take it as we can get it. Now, one of the other things that's kind of fascinating is Andrew Spector, who's the husband of the wife that's in an investment club in New York. So maybe he's looking over their shoulders. Who knows what's going on there? But he's gained $700,000 in the last 2 weeks. So that's
Timing is everything.
that's just a work of art in progress. And the Orange County Club has also tacked on just 300,000 in the last week. So nice. 1 week to go. Here's a reminder that we are going to be kicking off on the next version. Like I said, we've already got like 20 participants that have sent their stuff in there. We do reset the values to $1 million groundhog dollars on the 2nd of February, and we will be doing that. But you're all invited to play along, whether as an individual entry or a group entry with some of your partners in your investing group. All right. Anything at this point, Ken, that we need to take care of, or should we launch?
Let's look at some of these screens, Mark, because I think that's really interesting to folks.
All right, we've got some stuff here to show you guys. We're going to take a look at the analyst consensus estimates for 1 year going out. We used to publish these every Friday. We'll probably go back to something like that here pretty soon. That's one of the things I've been trying to talk Pat into doing, trying to sneak a few more ideas for some of those explosive winners out of Mr. Donnelly. And any peer pressure that we can put on him is appreciated. I'm not going to give you his email address because I think he'd probably get a few emails. But yeah, anytime he's on these programs with us, put a little peer pressure on him. Hey, the triple play, we've talked about that quite a bit. Ken will take us through that. It's usually most useful in bear markets and severe corrections, but it can be used all the time. Want to just underscore a point, and it's basically the basis and foundation of manifest investing in reality. Kurt spends, and it's not 5 minutes, it's not even 2 minutes, folks. It's less than 2 minutes making his groundhog selections every year, and we'll show you where he finds them. He's at 18.3% over 10 years. That's per year. We'll talk a little bit about Irish Spring, and then we'll go on with some more slides. One of the things that we do take a look at, we do have the analyst consensus estimates for the next 52 weeks, the next 1 year period. So if you're really looking to go deep value shopping, and some of these are a minefield, but these are projected to basically be home runs or grand slams in the coming year. I will tell you that the accuracy goes down as those numbers go up. It's something you always have to remember about when you see these type of forecasts from the rhinos. The higher those are, the less likely they are to be right. Some of these probably are right. I think it might be fun to come back a year from now and look at this chart and see if any of those come close to triple digits. Anything on this list jump out at you, Ken?
Well, we've talked at length about global cord blood. It's a big pick in our Mid-Michigan contest here by a lot of folks. Very interesting play out of, it's an American company actually, but the play is a Chinese play. It's does all of its work in China, and very interesting to take a look at that. I'm going down this list right here, and there's not a whole lot of familiar names to me. So I'm jotting down a few tickers that sound interesting just on the basis of name, if nothing else.
Yeah, and I should disclose I actually do own some shares of Global Cord with my fingers crossed. It's in my non-core portfolio. And the one at the bottom there is one of our small company selections for this year, and I think I may have selected it at one of the two conferences on that slide a couple slides ago, Repro Med Systems, in theory hoping to generate some return from the battle against the viruses. Anything on this one grab you, Kim?
Greenlight Capital.
Greenlight Capital.
Is that who's the hedge fund guy who runs that one?
David Einhorn.
Yep.
Yep, he's had some tough years, but he's making some noise here lately. He's involved in that Green Brick Partners that you may have heard Matt Spielman talk about last week.
Yeah.
And there's some stuff going on in that Matt has been doing the play-by-play on. Since most of these, notice that the quality ranking column is pretty sparse. Ran the same thing, only sticking to just the top decile, that in the top 10% of all quality rankings, just to give a tamer list that might be worth looking at. And Employers Holdings is a roundtable selection by me a few months ago, so FedEx has been in there. a number of these companies. Alimentation Couche-Tard, we're going to talk about that in a minute. I'm thinking about that for tonight. Notice you got a couple tobacco stocks there with Altria and British American Tobacco. But again, those are pretty decent return forecasts. And again, the accuracy probably goes up a little bit as those numbers come down into more normal ranges. Anything
If you're looking to move, if you're looking to move into a defense contractor, something that has a little bit of a extra boost because of the government intervention, look at Mercury Computer, MRCY. It's down near the bottom of this list. Really nice SSG to take a look at, and there are some interesting competitors to Mercury Computer as well.
And I will let the audience in on a little secret. I know Pat Donnelly is sniffing around at Mercury Computer. So I can state that as a fact. So for what it's worth, and it's been worth quite a bit here lately, Mercury Computer. Kim, anything on here?
No,
Well,
nothing. I mean, I like the Canadian stocks because a lot of my relatives are Canadian.
I'll balance Pat sniffing with the fact that I'm sniffing around Mercury as well, Mark. So,
Okay.
So Pat's near the top of the list. I'm near the bottom. So
that.
Balance that, folks, as you do your thinking.
It just canceling each other out there.
We're also we have two of our model clubs here in Mid-Michigan studying Meritage homes along with a number of the residential home builders. So Meritage is in the mix as a really high quality, interesting company that builds houses.
Yeah, and
any of you guys taken a look at any of the title companies? Because if all these people are getting brand new homes, they got to get the titles on their homes taken care of, and some of them may have to get PMI insurance.
It's not a title company, but one of my clubs, one of the model clubs here, just bought Essent, Kim, and Essent is private mortgage insurance. They did a pretty nice dive, led by a guy that's been dealing with insurance for lots of years, and we really like the possibilities of that company. A lot of the people that are buying homes don't have 20% to put down, and therefore have requirements of different degrees to put PMI on their mortgages. So Essence, a nice looking SSG, and again, you can find competitors fairly easily to compare it to.
Yeah, and in fact, I'll table it for now, but we're gonna come back to a quick discussion on monopolies and a potential future subject, and you'll find that there are very few companies in that line of business. All right, let's talk a little bit about triple play. Basically put together a list of companies that appear to qualify. I went through and I kind of did a real quick look. Can't guarantee that they all qualify, but they're all pretty strong candidates mathematically, within our database. So from top to bottom, those are some fairly interesting companies. And Ken, I'll let you go ahead and describe why these are interesting using your Alimentation Couche-Tard roundtable selection.
Well, Nicholson, as almost a throwaway in the 1984 Investors Manual, at the bottom of one of the pages, put a small paragraph in. It looks like the editor had white space, and he said, "Can you write something to go here?" And so they filled it in. He called it a triple play. He obviously had written about it prior, and he said basically that he liked to see three things happening, especially at the end of a bear market, but even during other kinds of markets. If he could see those three things happening, then it was the kind of company that he would move to the top of a let's study list. It's by no means a home run. It's by no means a buy. It's by no means something you're going to say, I don't have to do any work on it because it is a triple play. But the recommendation was move it to the top of a let's study because it really has some characteristics that are very desirable. One of them was you wanted to depress stock price. And the way we interpret depressed stock price on a value line sheet, at least, is to look for the projections going forward. That's on the left-hand side with the circle around it right now. And we figured that projections at the low end that were into the double digits and projections at the high end that were into the 20-somethings or higher qualified this as a depressed stock price. These really high returns indicated that the stock price was a little bit lower than it really should be at the particular time we were looking at it. So that was the first leg of the triple play. The second leg was the possibility that the PE ratio could expand. And to see that, you kind of looked at the top center where the PE ratio of 11.5 at the time the study was being done is displayed. And then you also kind of look at the first circle on the right-hand side there, where you can see the 2019 average PE ratio as just under 14, and the anticipated PE ratio 3 to 5 years into the future at 16. So an expanding PE ratio, those of you that have been investing for a while know that PE expansion really adds a lot to price appreciation. So leg number one, depressed stock price. Leg number two, the ability for the PE ratio to expand. And leg number three, an expanding margin, net profit margin. Remember, that's the pre-tax profit margin after you take the taxes out of it. And the net profit margin, again, look at the 2019 value, which is an established real value, 4.3%. The next number, the 6.8%, is still an estimate. It's in dark italics, but you go over to the far right, the 3 to 5 year estimate of 7.8%, and there's your increase in net profit margin as well. All three of those things have possibilities of happening. This makes it a triple play, and this makes it a very interesting company to study. All of the numbers that Mark has gathered onto this chart make it a really interesting play. The RSI down around 30, the ACE price to fair value of about 80%. These numbers all taken as a whole tell me that this is a company, 94 quality on top of that. This is a company that I might really want to take a look at. Maybe it goes into my Groundhog,
Well, it's definitely on my short list for Groundhog potential, and thinking about it for tonight also. All right, let's go ahead and switch gears to, we mentioned Kurt doing this in less than 2 minutes, and that's not an exaggeration. We ask him for the tickers. He comes up with it in like less than 2 minutes, and we're not joking. If you go to Manifest Investing and hit the research tab and scroll into the companies area, you get a default screen, which is kind of a starter screen generated by the sweet spot, companies that are in the sweet spot that also happen to have, in most cases, pretty high quality. And this is what he looks at. He basically looks at this list and he starts peeling off the companies at the top. And I could probably predict the ones that he would grab. And Ken's going to bring D.R. Horton tonight to the roundtable. Aflac's been a recent selection. Google, we've been talking about Google quite a bit, but there's a number of interesting companies, including pizza and beer, on the list. So those are definitely staples. All right.
Pizza, beer, and Red Bull, Mark.
There you got everything covered. That's the after dinner drink now? Monster beverage?
I don't know.
Well, and then you just get in the RV and relax and chill.
Yeah, you got LCI on there. There's a lot of companies that have served us well over the years that they're not spectacular return forecasts, but we know better than to get too greedy when all these bubbles are floating around in the air. All right. One of the companies that I ran through the quick audit task was this Makita. Ken and I had both noticed this one during some of the screening efforts, and in Manifest, it basically had a higher growth rate that was dominated by these 3 years of analyst estimates on the right-hand side up there at the top. And if you really factor in the longer-term picture for the company, it'd be pretty easy to end up in the mid-single digits for a growth rate estimate. That kind of changes the outlook on this one. It's still pretty good, but it's just not, it probably would not show up on the screen under that set of assumptions. That's just an example of, again, these 3 years were dominating the analysts. I think we were only looking at this period here, but when you go back a little bit further, again, it's pretty easy to defend a lower growth rate than 10 or 12% for this particular company. It's a great story. It still is a good story. And just to give you some idea. All right, our last of our 4 opening screens here, Irish Spring. It's a reference to Hugh McManus and his practice, and I would call it a best practice of shopping for companies that are trading near their 52-week lows. And what we basically feature at Manifest is a look at what's called the upside position. In other words, where is it on this scale between the 52-week low price and the 52-week target, according to the analyst consensus. And so a company trading near its 52-week low would have an upside position approaching 0. And that's what you see at the top of this chart. Strayer qualifies. That is now strategic education for a closer look. I happen to think, in talking about Groundhog shortlists, eHealth is on mine. Pretty decent trading near the low, pretty reasonable numbers across the strip. But there's some pretty good companies on here. Some of them are repeats. Might be interesting. Hopefully you can make it tonight. He might have some commentary on Gilead or some of the other things going on in that market. So again, he gets very interested when they get below 20. He starts losing interest when they get above 30 because he is extremely patient and willing to wait. Any thoughts, Ken?
Well, there's a lot of familiar names on here. I'm surprised to see a strong company, a big company like Merck on a list like this. That is interesting to me because especially as you get older, a lot of times you'll move towards more established companies that pay a dividend to kind of mellow out your portfolio. And Merck is usually not the kind of company you see on a list like this.
Yeah, and I can't help but notice Lockheed and Northrop Grumman on this list. That they rhyme with your General Dynamics, Ken.
Yeah, they do. Yeah.
So they've all been kind of ratcheted down a little bit, and the military-industrial complex doesn't seem to be slowing down right now. Kim, any thoughts on this list? Any thoughts on eHealth? Has that shown up on your screens at all?
No, truthfully, it hasn't. I read so much, I have more ideas than I know what to do with.
Well, we need to turn you loose on Green Tree Hospitality. That's a Chinese hotel company, and you love the hotels. You love lodging. Because Green Tree keeps showing up on these. Green Tree Hospitality. I'm going to take a closer look at it myself. And Ken, you're not allowed to be interested in any more Chinese companies.
Don't want anything to do with that Chinese company. I'm sorry.
All right. Well, I'm showing we've got a little over 10 minutes left. Here are some of the other screens. You can read as well as anything. Here are the 4 we're going to touch on briefly. The relative strength index, again, that's just one indicator, but it's one that has been extremely rewarding to us here in the last year or so. So we'll check in on that one. Morningstar and the analyst consensus. We do like to keep track of those, although we're aware that they don't handle some of the early stage and some of the turnaround situations very well, and we factor that into what we do. We also see the analyst consensus getting pretty frothy. I do love the image there that unicorns let themselves go. Just a quick nod to the ivory screen. We'll take a look at that, and then we'll close down with a quick look at the companies which rise to the top of my current favorite, the latest entry in our arsenal, this projected return on value. You've heard us talk about it many of these sessions, and we'll take a look and see what that screen has generated. Here's a relative strength index, RSI. on a number of companies. And again, we begin to be interested at under 30. And if we can get it below 20, even better. And there's some fascinating names on here. And the only factor we're looking at here is that relative strength index. It's a momentum indicator. It's kind of trying to figure out the vector of the rhino crash. How's that for some sneaking in some math here, Ken? A little bit of engineering. We want to figure out, what these institutions and crowds of investors, which way are they running and how fast? And sometimes that can present us with those pendulum opportunities you've heard Ken talk about so much. There's a number of interesting companies on here that are trading in that oversold or undervalued zone. Anything jump out at you?
Yeah, the one negative at the very bottom of the list, what's going on here with the ACE community at a negative 70% on First Capital?
Yeah, I checked that number because it was so weird. I don't know. It might be a matter of very few analysts covering the company and just forgetting to update their files. I mean, they're looking for a $15 52-week price target. The stock's at 55. So that doesn't make any sense. That's just an example of, again, and we can't say it enough, these are screening things you want to audit, you want to check and trust but verify anything that you're doing here.
Well, and there's not a database anywhere that doesn't have errors in it. So it might be due to some kind of an error at some point too.
Kim, any awareness of Cardiff Oncology?
No. Is that the one that there was an article that had Ardelyx getting their price target raised, and there was another company with it that was getting raised? I don't know if that was the one with it.
I think it was. And I'm actually I'm feeling good here because I feel like I'm giving you homework for a change. It's usually a one-way street back at me that, you're always giving me these great ideas and books to read. And
well, that's why we all do this for everybody in the audience, because we all see things differently, and by seeing it differently, we notice things, and that helps us all be great investors because none of us is wired the same way, so we see things differently. For some reason, I remember Black Knight. I can't remember why. Black Knight, and the other thing that strikes me on this list is Anheuser-Busch, because there's only I want to say oleopathy of how many manufacturers in the beverage industry, and Bud is one of them. So why are they down so much? And I don't think that they're going to ever go away, because I don't think alcohol is going to go away.
yeah, that's talked about in that book. We're going to show a picture of that book here in a few minutes about the oligopoly on 70% of the adult beverages come from just a couple of companies in the world. And
Are we talking about the same book?
Yep. The one that you stuck on my to-do platter. Okay, so there's some interesting opportunities. The one that I would just, if anybody is out there looking for a conservative investment, it's been actually driven up a little bit, but it's subsided. Colgate-Palmolive is kind of a fascinating entry at the top of that list. All right, here's just a quick nod to the Morningstar price to fair value and the analyst consensus price to fair value. Again, just a trigger for potential ideas. This is deep value shopping, so there can be some real nonsense on here. They're basically suggesting that Nissan is selling at 62% off of its fair value. It's up to the audience to figure out whether or not that could possibly be the case, when, by the way, the analyst consensus says it's trading at 94% of their fair value. So you do get some different opinions here, but those are the deepest bargains according to Morningstar as of today. I did take a look at the railway here, the Guangshan Railway. That's down in China near the Hong Kong area. And that might look like a somewhat interesting look, especially since it's got a decent projected return on value. So I may play with that one. a little bit, but dealing with Chinese stocks in Ken Kabula's world is frightening. All right. So, and then same story here. The analysts tend to be quite enthusiastic, and there are some interesting companies there. I think XPEL was just added to coverage at Value Line, and just there for the taking. Here's the output of our Ivory soap screen, current Ivory soap screen that I basically lean on this anytime I'm looking to invest real dollars. Searching for companies with a manifest rank greater than 99.44, hence the Ivory soap reference. What this is just a short list of companies that have elevated return forecasts, not too elevated, because we penalize them if they get too elevated, but that in combination with high quality. And there certainly are some interesting companies on there. In fact, coming back to what Kim was talking about on the mortgage finance, when Ken was mentioning Essent, that whole area of home buying, serving the home buyers, is an interesting area to explore when opportunity presents itself. And George Mack is also, I believe it's George, has been talking about this Virtu. I need to do a deeper dive on that one for sure. It's new to Value Line. It will be updated next week, and kind of a fascinating potential there also.
Mark, can I make a point about the dashboards that are coming off of Manifest? I'm seeing something that I haven't seen a whole lot of in the last 10 years using Manifest, and it has nothing to do with the way that the data is collected or what Mark is doing, because Mark is doing nothing more than reflecting the values that are coming from the analyst community. So it's the analyst community that we should be pointing at. And I'm pointing at companies like ASML at the top of the list, or Market Access at the bottom of the list, or Royal Gold in the middle of the list there. And I'm looking at that projected PE value. That's an average PE value going forward. And I would like you to be very careful when you see a big number there, because a big number there usually results in a fairly large number off in the par column. And if that big number is commensurate with what the company's been doing over the last 4 or 5 or 6 years, that's one thing. But I'm finding PE values going forward that have just exploded compared to where the last 4 or 5 years PE values have been. And when I see that happening, I want to do my own study with my own average PE, and that doesn't change necessarily the quality of the company, but what it does change a lot of times when I do my own study is the par values that are attached to those high PE companies. So I'm just suggesting, ASML is kind of high at 38, but I really am suggesting with Market Access, for example, it's a wonderful graph on an SSG. It's an interesting company to study, but I'm suggesting that the PEs might not stand up to your analysis, and that if you do your own analysis, you might find the par values are going to be lower than they're being reflected right now on the dashboards. Again, nothing to do with the methodology from Manifest. It's just that the numbers coming from the analyst community maybe are starting to swing a little bit to the too optimistic side, to the place where we're getting kind of frothy PEs for average PEs going forward.
Well, that's a nice segue, Ken, and they're going to think we practice this. Yeah, it really does have to do with, you talk about bubbles, the bubbles in the analyst's imagination in some of these cases, and they basically get whipped around by the analysts that cover these companies. And that actually leads us to this, because you can do the same thing, only leave the PEs out of it with projected return on value. and you're not vulnerable to the bubbles coming from the analysts. And what you see here is the same type of information, only I've provided the excellent quality companies who have double-digit projected return on value. Starting with George Max Virtu Financial up at the top. A2 Milk I brought to the round table last month. Thinking about it again for tonight, but I think I'll probably go a different way. But what you see here is a fairly decent list, and I think it's less vulnerable to some of those distortions that Ken was just talking about. And it's a topic that we will be carefully continuing to explore. That's why we've talked about it so much. This is a good list of companies for study, and I'm sure some of these are going to make my short list for sure for the Groundhog and for tonight. Your thoughts, Ken?
Yeah, Mark, I've been doing my own rule of thumb as I explore and use Prove. And I've been saying to myself, when Prove greatly exceeds what I get as a par value, that's telling me that maybe I've chosen an average PE that's a little bit too low. And I should consider raising my average PE as I do my analysis. When Proof seems to come fairly close to matching the par value, that's giving me kind of a validation that I've chosen a PE value, an average PE value going forward that is usually in the ballpark at least. And when the Proof value moves decidedly lower than my par value, that's suggesting to me that perhaps what I should be doing is looking at my average PE and cutting it back a little bit going into the future. That's been helping me, I think, come up with SSGs that, to my mind at least, are trying to take the emotion out of the SSG and are trying to discount the pendulum swinging back and forth with the analyst community. I'm very happy with this whole idea of Prove, and I'm hoping we get to the place where it's going to be a number that we can display on the manifest dashboards. I think that'll be very helpful in the long term.
Yeah, that's definitely in the queue. And I just, in just echoing and reinforcing what Ken had to say, that graphic on the right up at the top, that I think about it in many of the same ways that Ken just said. It's all of those things where it forces you into thinking about the capital structure of the company, something that Kim likes. It just naturally takes you into this notion of substantiating or authenticating, and it's an area that can only make us stronger, I believe. So some good stuff there, some good RSIs on there, and a pretty good shopping list. All right, here's a quick reminder of how the companies in the value line investment survey land when it comes to projected return on value. Those of you that remember this chart from a little while back know that it's shifted just a little bit to the left, and it's actually a tighter bell curve than it was. And the companies that were on that chart on the preceding page are basically the ones here in the double-digit area. We're looking for the best ones in that on the right side of that bell curve. All right. One last slide. I just want to offer this up to the group. Last week we talked about the Broad Assets Investment Club out of St. Louis and how they typically are looking for those launch pad or escape velocity type companies. And what I've provided for you here is a list of companies that might fit the description of the type of thing that whets their appetite. And you can see the earnings number on the far right for 2020. At least the estimates for what is expected to come in versus the earnings estimate from the analyst consensus for 2021. And we're looking for the companies in the database that have the biggest jumps. basically jumping in some cases from a negative number to a positive number, and hopefully taking off and staying there, achieving escape velocity. So pretty decent list of companies to give some consideration to. And again, a couple of these are going to make it to our list. All right. That graphic of the book, Escape Velocity, is by Jeffrey Moore. And I was scratching my head trying to remember how I know this guy. He wrote The Gorilla Game, a book from, I'm guessing, 25 years ago on picking high-tech winners. And he also wrote the book Crossing the Chasm, and that rhymes with a recent presentation that Ken and I did. So I'm going to have to, I'm assigning myself some homework here, Kim. Take a closer look at these.
I think you've got plenty of homework already.
Very true. Very true. Okay, so these are here for everybody to take a look at, and I might copy this slide down to the ladies in St. Louis. Not going to talk too much about books here today, other than to point out one that Kim has been kicking around a bit. I'm going to save that one for the future. That's Charles Carlson's book, The Individual Investor Revolution. We'll come back and talk about it. But I want to pull up this one because I think it actually fits very well with some of the discussions we had in Life After Google, Ken, from a few months ago. And Kim brought this up, and it's been kind of gnawing at me. I don't have the book yet, but I've read parts of it. The Myth of Capitalism, and it's not as dire as the title sounds, but it is an interesting treatment of this notion of monopolies. Kim, do you want to go ahead and summarize? I don't know how far you are in reading it. I know, is it part of your book club effort right now?
Yeah, we are finishing up the book next week, so I'm 3/4 of the way through it. But those of us in manifest investing like small caps because we feel that they're going to grow faster than the large caps. Well, what this book talks about is it really can be that the large caps gobble up the small caps because they don't want any competition. And in the myth of capitalism, our governing bodies, meaning our government, and antitrust laws have made it that may be why we have a wealth gap. They bring things together in this book I had never thought of before. So it's kind of very eye-opening, and they talk about that in some areas we only have 1, 2, maybe 3 companies who are taking over all of a certain area of the market. And let it be life insurance, let it be banking, social networks, internet services, consumer goods. So I'm a true capitalist because first thing I thought of as I'm reading this book is, okay, I need to make a dashboard of all of these stocks who are number 1, 2, or 3 in each industry that's in the book. And that way, if they ever, if you ever had a pullback or had some volatility, that could be part of my pounce list.
Yeah.
It's very interesting in how the author even says that he wishes that every member of Congress and the House of Representatives would read this.
Yeah, it's quite a topic, and it borderlines on going a little bit political, especially with some of what happened with Google, Facebook, Amazon, and Twitter here over the last few weeks. But notice that the mortgage title insurance that we were talking about a few minutes ago are in here. I would also, this is almost an accident. This notion of social networks and their potential impact on things like the GameStop price manipulation that we see going on. I think putting this stuff in context and understanding the antitrust environment, how little of it's actually been enforced over the last few years, and how to think about it if it were to be enforced in some way. I don't know, Ken. I think it's worth a little bit of a closer look. I would also point the audience to that YouTube link at the bottom. Denise Hearn, one of the co-authors, gave a presentation where you can spend a half hour or so getting a pretty good orientation on some of the concepts behind the book and decide for yourself whether or not it's something that you might want to dig into. Again, I would place it in the same category as life after Google, in terms of thinking about what might, let's be prepared. Let's be aware and be prepared for this sort of thing. And in the meantime, how can we maximize or optimize our opportunities as investors?
Absolutely. One of the most interesting things I thought in it is many of us have our Delex in our portfolios because of Hugh's presentation. I never realized until reading that book that like over 40% of drugs that are brought to market specifically are brought to market because they hope to be acquired.
Oh, absolutely.
And the big boys will gobble up the little guys, and there you go.
Mm-hmm. Often making us smile in the process. All right. All right. Just a reminder, there is a place where we archive all of these sessions. If you go to YouTube and just enter Manifest Investing, you can actually see the sessions just on display there, including the roundtables. And you can see down at the bottom of the page that Successful Investing 2. In fact, if you want to go back and take a look at those selections by Pat Donnelly and his friends from November, it's right here in this presentation. You can see some of the thinking behind some of those. And then we'll just close down with one more Bernie shot and the sentiment that we all wish we could be on the beach in places like where Kim is now. So that's where our bull is for this week. All right. So with that, I think we can go ahead and close down unless you've got anything else, Ken?
Nope, nothing except stay safe to everybody out there and join us tonight for the roundtable.
We've handed out a massive amount of homework, and please bring out your best ideas. So best wishes and better investing to all of you. And we'll see you tonight and see you next week. Thanks, everybody.
Thanks, everyone.